What's going on, guys? Welcome back for another episode here of Let It Grow Investing. I'm Jeff. I think we're up to like 337 episodes at this point. It's been a long time. It's been a labor of love. I think this is probably year 4. To be honest, I forget. But thank you guys for being here. Please make sure if you're new here to like and subscribe. It definitely does help the podcast grow. Plus, you get to get those weekly updates from me over here. So yeah, man, it's was a decent Monday for us. We had a decent beginning of the week, and then we had a little bit of tapered expectations on Thursday, and then we had Friday off, a long weekend. We normally don't see a huge rally into a long weekend, especially during times of war or times when there's blood in the streets, right? So I didn't really expect Thursday to be this, rocket ship of a ride, and we're going to go into the weekend super green. But Monday, I believe we did return about 2.9%, and things were looking pretty strong. So what's the psychology of the market right now? What do we feel? What's Trump doing? Really, where do we go from here, right? Last time we talked about dollar cost averaging and staying in the market. That is really the thing. Do we want to go all in? Do we want a dollar cost average? And why, right? There's a lot of different thoughts here, and there's a lot of different opportunities that we're really, facing right now. So I'm just trying to wrap my head around what I'm doing. I've had a lot of these snow checks start rolling in from jobs we did back in January at this point. And yes, it's April 5th as I'm recording this. So happy Easter if you celebrate. And so I'm really trying to get a feel for what I'm doing with my portfolio. So if you guys are paying attention to the news, we did get that expletive text from Trump on Truth Social. That came out this morning. I don't condone it. I don't really want to take sides with any politician. And truth be told, I don't really trust any of them. I think that they're all in it for their own gain to some extent, or they are thinking about that. They're trying to make their own money. They're trying to do things that make them more money. And I mean, you've seen that with other politicians, stock picks and their gains over time. So, but what does that mean, right? Well, I'm looking at this, trying to find it as a gift, right? So this says Dow futures fall over 300 points. That's tonight for tomorrow morning as Trump threatens escalation, oil prices rise. So we're looking at more and more problems with what Trump said, and basically, Iran is going to face hell if the Straits of Hormuz are not opened. So that is the fear right now. That is what we are watching. There's a lot of different things here that this has got a paywall on it. I didn't realize that. So I'm going to go ahead on the CNBC and see just what's going on here, right? So we've got stock futures are slipping after a winning week as oil prices tick higher. So again, plan on a rocky start to Monday morning. That's kind of why sometimes I let a little bit of that volatility kind of shake out of the market. We normally invest in the for the investing challenge lunchtime on Monday, right? 12 is when I've got my reminder set. Sometimes I don't get to it until 1 or 2, but I try to sit out of the early morning volatility because you've got a lot of news to digest from the weekend, right? So I'm looking at that. We're looking at Dow futures down to 253 points or 0.5%. S&P and NASDAQ down 0.6 and 0.7 respectively. Wall Street coming off a strong performance. S&P soaring nearly 6%. Gain snapped a 5-week losing streak and marked the benchmark's best weekly performance since late November. Dow and NASDAQ also ended the respective 5-week slides. Former advanced 3% for the week, and the latter being the NASDAQ popped about 4.5%. Those gains weren't easy to come by. Major averages experienced wild swings during the week. Traders assessed updates on the U.S.-Iran war and gauged when the conflict may end. Now, I said what I said about politicians and politics in general to say that I don't think that Trump is really just trying to sink the market, right? I don't know that there's a tried and true path here. I'm not 100% certain as to what happens if we go into war. I know that he's willing to go into temporary pain for long-term gain. We've seen that time and time again. But I think some of the verbiage that he used, while over the top, is also scaring the market, right? This isn't like a little tap on the shoulder that, hey, open the Straits of Hormuz, or we're going to sanction you or tariff you or anything like that. This is promising larger escalation. So is that an empty threat? I don't think so. He's already shown before that he's going to go ahead and take out their different sites and whatever that might be for him or for this situation. But I do know that that man loves money. And I don't think that he's telling his people to sit it out. I think he's probably looking at it as a time to buy in. If he's saying that we're going to potentially have a bunch of problems and he's going to threaten, well, that's going to tank the market. But hey, maybe his inner circle's got this news like, well, yeah, he's going to do this, but hopefully we can come to a some sort of ending and resolution to this by, I don't know, say April 15th, say May 1st, say May 30th, whatever that might be. Pick a date and kind of know that we're going to be in a lot of volatility in the market until then. So last time when I'm talking about do we want to go all in? Do we want a dollar cost average? Well, this is why, right? If I told you last week to go all in, if I got 10 grand sitting, put it all in, buy the S&P. Yeah, well, this last week it did great. But now this coming week, we could tank the market more than what we made this past week. So that's why I stick to the plan of dollar cost average. When your positions are down more than 10 to 20%, double that allocation until they get to a point where they're within 10% of their all-time high, right? So if Microsoft is down 30% and I'm normally putting $100 in a week, well, now I'm going to go to 200. And then I'm going to repeat that cycle until Microsoft gets right up back to almost within that 10% striking distance of their all-time high, or at least within the high of the past 12 months. That's probably a better way to do it. All-time highs can get skewed, right? There's a lot of different things there. So within the last 12 months. So, something like Intel might have had a much higher high 15 years ago, and now they don't, or Cisco Systems, or, name another stock, right? So I'm looking at those as being a gift. I don't want to go all in, but I do want to invest more money while the stocks are diminished, right? I can buy more shares with my money, and I want to stock up on these things while they're on sale. So I'm not telling anyone, nor would I ever say, push all your money in right now. This is the time, because if you're wrong, it's going to be really, really painful, and you don't have any money left to buy your way back out of it, right? So if you have that 10 grand and you're comfortable putting in, I don't know, $1,000 a month or $250 a month or whatever that number might be, go ahead and nibble, but nibble a little bit larger right now, and try to get more shares on the discount. But again, I'm not going all in. I'm not, basically saying that is a good idea. And I did pull up something, and this is just a little chat GPT, investing versus sitting out on the market, right? So I'm just going to pull this up. And I know that AI can make mistakes, but I'm just looking at it long term. And really, what does this mean for us? So what am I thinking? Well, we're looking at what happens during down markets, right? Market declines like 10 or 20% or worse are normal. And we've hit about 11%, 10.5%, 11%. That's normal, right? We've had much bigger sell-offs. We had them during COVID. We had them during the dot-com bust. We had a lot of these big drops, right? But we only experience bear markets minus 20% every 4 to 6 years. Now, some of your individual stocks have gone down more than 20%. That's not what I'm talking about. I'm saying the market as a whole, whether it's the S&P or the NASDAQ or whatever that might be. That is what I'm talking about. So they still are returning 7 to 10% annually over the long term. So you're still making that money back even with these garden variety everyday 10% drops, right? And we do see these bear markets minus 20% every 4 to 6 years. So staying invested or buying the dip. If you keep invested during downturns, you're going to buy stocks at lower valuations. Future returns tend to be higher. We're looking at compounding continues uninterrupted, right? So after the 2008 crash, the market more than tripled over the next decade. If you were buying during that the mortgage crisis, we had huge returns over that time frame. After the COVID, market recovered in months and hit new highs. If you go to cash, you might avoid some short-term losses, right? You could have saved a little bit of money if you timed it perfectly on March 11th and sold off. You probably would have got out of some of the COVID drop. But then were you smart enough, wise enough, risky enough to buy back in on April 1st? And most people weren't, They really thought, well, this is going to be the end of the world. There's a lot of problems. We're not getting out of this thing. Everyone is, unfortunately getting sick. And, we just were not in the mindset of let's go ahead and buy back into the market as people are going out of work. Their businesses are closing. All those problems are going on. People weren't really thinking, well, yeah, I need to buy back into the stock market. It was hunker down and save all your cash time. So if you stayed invested, you were good. But if you sold out, you probably missed that entry back in. But you're risking the best recovery days, and that is the issue with selling out and going to cash. And the biggest up days often happen right after the worst declines. We've seen that, even this past week with the market kind of, we had 5 weeks down, and then we just randomly turn it back over, and we're like, all right, well, we're oversold. We need to buy back in. This is, just overdone at this point. It's overcooked. We got to take it out. And we're seeing that, right? And if I told you, last week, like I said on Monday, I was buying 2 stocks instead of just one. We bought Microsoft and we bought Celsius. And okay, even if I didn't even take a look at these this week, but I'm still fine with knowing that I doubled into my position and bought heavier after 5 weeks of the market going down. So you're also going to be missing the best days, right? Classic long-term study shows that if you're fully invested, you get about a 10% annual return. That's a mixture of probably, let's just call it the S&P 500. We're going to say those 500 highest stocks in the market that are just kind of, returning that 10% average per year. If you miss the 10 best days over 20 years, your returns cut nearly in half. So every time you decide to sit out right before and you don't get back in, we're going to only be making about 5%. And if you miss the 20 best days, you might get back to flat. Those 20 best days can make or break your portfolio. And all you had to do was sit in the stocks that you were in and not sell them. A lot of people have a lot of psychology around this. We're going to see this here, waiting until things are safer. Market rebounds before it feels safe, right? The fact that, the crisis is still going on, but the market kind of starts seeing some signs that, all right, well, we're back to reality. This war is not going to go on forever, but these stocks are going to go back up before that war is over, right? They both can exist. It's not just a, single sum game. There can be 2 outcomes here. The market can go up while we're still in war. It's happened and it's going to continue to return, things like that, right? There's a lot of fear, but the market can still go up because life still goes on. You re-enter too late. We talked about that with COVID. Real edge, down markets equal opportunity. Lower prices, higher future returns, right? Like I said, if you're buying it when it's at a 20% dip, that means that you got 20% to go back up to that all-time high and then break out to the upside. And does that always happen? No, but a lot of times it does. So you're getting those high-quality names. If you're buying high-quality names, S&P 500, NASDAQ, Dow names on a dip, and you're maybe not playing penny stocks, right? Those could be a little bit going to be a different animal, different beast altogether. But if you're buying those names that are tried and true, high conviction, you're getting potential higher future returns. Dollar cost averaging works best in this situation because you're buying more shares and it's at a better valuation. Long-term investors are going to get rewarded. So sitting out might feel safe, usually more expensive long-term, right? You're going to get diminished returns. If you miss 10 days, you're going to be cut in half. And if you miss those 20 best days, you might be lucky to break even. Time in the market is greater than timing in the market. So that is what I wanted to kind of tell you guys, and ChatGPT broke it down for me. And I think I've said all this before, so they're probably pulling from some of my old podcasts and giving me my own information back. Maybe doubtful, but you know what? We can be optimistic here. So that's what I'm getting at. Do we want to go all in? No. Do we want a dollar cost average heavier? Yes, that's what I want to do. I want to be buying more shares in order to be taking full advantage of this market, right? Now, if I buy heavier tomorrow, do I think that it's going to go up this week? No, I don't. I don't know what Tuesday is going to bring. I don't know what Wednesday is going to bring. The Strait of Hormuz could be a just complete escalation, and it could go down even more, right? We could enter bear territory. We could sell off another 10% if things really get sideways. But that is why I'm telling you not to go all in. It does not make sense to push all your money in because we don't know what the outcome is going to be. It could go lower, and then you're going to have a better opportunity to buy more stocks on a discount. So a lot of those reasons here that I am cautiously optimistic. Is that fair to say? I think that's probably a good way to look at it, right? Like, I don't want to be steered out of the market. I'm comfortable buying a lot of things here. I haven't been glued to the market, but I still look at a lot of different things that really do make sense to me. Micron, man, Micron. I'm going to pull this one up, man. Micron just seems like it's too cheap to avoid at this point. Like, I really like the stock. The valuation is very, very reasonable. And I think we're getting kind of steered out of AI right now. Like, people are not going into tech. People are going into utilities. They're going into oil. They're going, Chevron and Dominion. We're not looking at tech names. Tech names are going to sell off the most during this time because they've already run up so much. So the fact that people are a little bit worried about AI, okay, well, that's all well and good to me. I can use this as a time to go ahead and purchase more shares on a deeper discount. So that's what I'm going to do, right? So I want to take a look here at this detailed stock report from Micron, and we're going to take a look here. And you can see right off the top, right? Trailing PE is a 17. Forward PE is a 3.9. And 3.9 on a stock that is that closely tied to AI. And there's such a backlog and demand for AI. I think that this is a great stock to buy right now. You got 42% of upside. We got some up revisions in the last 120 days. We got earnings per share taking off from from $8.29 to $57. Is that real? Man, I'm surprising myself on that one. From $8.29 to $57 for 2026, they are going to be printing money. And then $96 by 2027. That is fantastic. So we're looking at annual revenue going up 189% for this year and 363% by the end of 2027. This stock has had a huge run, right? And I've been very mindful of this. I had that covered call last year, and I sold a lot of it in the 250, 270 range. I don't even remember anymore, right? Like, it's out of sight, out of mind for me. I was telling you guys to buy it in the 80s and 90s, 18 months ago, and it had this just massive run. Well, I'm finding this as another time to buy some more Micron. We've got dividend growth, 7.6%. Dividends about nothing. Dividend payout is super low. We can cover this dividend for days, for years. It doesn't, whatever you want to say. 35 times dividend coverage is fantastic. Yields and margins. Revenue growth is 85% year over year. Gross margin, 58% growth year over year. Return on equity, call it 40%. Net margin, 41.5%. Those numbers look fantastic, right? So we've got, what else we got? I wanted to get down to the forward PE. This is the one that I am just, drooling over. The fact that we are sitting at a 3.9 and the 5-year average is a 17.7. That is a 78% discount on a stock that has more than 4x'd. They probably 5x'd in 18 to 24 months. We still have this PE where it's a 3.9. So yeah, that PE, even though the price went up, the earnings are going up that much more that we are still trading so cheap. So we get down to the PEG ratio, and this isn't a misprint. It's a 0 because we can't divide like that. It's just a case where the growth is so far outweighing the PE in the forward PE that it's a 0.0. This is super cheap, and I'm going to be buying more of this. This is not on the investing challenge list for 2026, but yeah, I'm going to be buying some more Micron. Like I said, I got to move some money around, but once I get that money situated, I will be adding Micron. I'll also be adding back into Bitcoin. I've told you guys about that. I'm trying to build that position back up. But yeah, I did see some news on SoFi. I know they've got some competition, and there's some things there that I want to address. I'll probably have to dive into that and get into that next time. Nike is getting obliterated for a lot of the things that we've talked about before. We're talking about tariffs. We're talking about Going woke. We're talking about consumer spending. Oh, there is one more thing that I really botched last time. That FedWatch tool. I did get those numbers wrong. I looked at it like the end of the year was going up, but it looks like by the end of the year, we might get a quarter point cut. I was looking at it wrong. My apologies on that. So, yes, there's a lot of different things here, right? We're looking at Nike going down to $44.19, $43.96 after hours. That was on April 2nd. Is this something that I want to buy right this moment? Let's take a look. Let's get into some Nike stock. Let's see if this is even worth our time. Well, we've got a 26 times PE trailing 12 months. I was telling you in the upper 50s, I liked it. A lot has changed with the way of the war and tariffs and the woke stuff. I'm kind of past that. Where do we want to go here? We got a 3.67% dividend yield. I am down on it. I will show you my position here. Down, $2,000 on this individual trade here. But let's take a look at Definitive. Let's see where the earnings go. What do the earnings tell us that the stock price does not? Well, we got a forward PE of a 23. It's rated to buy. Negative returns for 5 years. Could have told you that. You didn't really have to dive too deep to see that it was doing better post-COVID and everyone was buying athleisure wear, and that became a verb, or not even a verb, but just like a new noun that athleisure was a thing. So we've got a stock that I do like. Like, I feel fairly strong that they can get out of this. The direct-to-consumer was a problem. We've talked about this probably a lot, maybe way too much, but I do like the company. Are they letting other people into the space? Yeah, Brooks, Hoka, some of the other names. I forget, was it VF? I forget the name of them. I know there was another outdoor running shoe that was kind of catching on Holdings. There's a lot of different things out there that have had a decent position in the market. It was VF Corp, and I can't think of the name of the shoe brand, but it'll come to me or I'll take a look. So we've got around 50% upside, whatever. I'm not worried about that from the analysts. This is the thing with the earnings that is tricky, right? We're going from $2.16 down to $1.53, and then we're trying to rebound for 2027. So we are seeing some pain in the earnings, right? We are seeing slight growth and annual revenue for 2026 and very, very slight 2 years out, right? 1.7% by the end of 2027. So if you're going to bet on this thing, this has got to be a long-term turnaround. We're coming down from annual revenue of 1.4 down to 46.3 last year, and we're barely getting above that for the next 2 years, and we're still not breaking 2024 numbers. So that's painful. Do I feel like this thing can come back? Yes. Is it going to be a quick turnaround? No. I mean, we're not seeing a quick turnaround. Do I think it oversold? Potentially. I'd probably have to dive in more into those. The yield's okay, but the dividend payout ratio at a 94.4 is scary. I don't like that at all. Dividend growth at 5.2 is just okay, but they really can't raise too much more because they're paying so high over here. Margins are garbage at gross margin at 40.8. Yeah, like that's fine, but they didn't make it down to the net margin. So gross margin really doesn't mean that much if it doesn't make it down to the bottom line. So do I think that it can come back? Yeah, I do. But I think you're investing for this for a 5 to 10 year turnaround. I don't think that this is going to be something where you're going to buy it and in 18 months, you're going to be like, oh man, I told you. So that's kind of where I'm at. I don't know if I really changed my tone or not. I still feel like it could be a strong return in time, but we're not there yet. The direct consumer helped stop a lot of problems versus, I mean, they went from all the different Foot Locker stuff, and then they were trying to get out of that. They were trying to get out of Kohl's. They went direct to consumer, and they cut off a lot of the sales, and not as many people were going DTC. So that hurt them. Can they backpedal? Can they steer clear of that? Potentially. Is it the time for an athleisure wear type company to make a comeback during higher inflation due to fuel, due to war, due to a little bit of economic downturn? No, it's not. So, I mean, that's why I'm saying you can't really expect this thing to just bounce back overnight. So if I were going to do that, I would be looking at tech names. I'm not looking at consumer, consumer goods to really do that quickly. And if I were, I'd probably be looking at larger players, whether it be, Walmart and Costco and Target have been doing well. They're not really the ones that you can really buy on a discount right now. I want to take a look at just where like a WMT is. We're going to take a look at that. And like Waste Management, because I was thinking WM. That's probably a decent stock right now, too. I'm sure they've had a decent little run because people are looking for less international exposure. And, that's definitely right in that line. So Walmart started the year 112. We're sitting at 125. So we're 10%, give or take. Target, let's take a look over there. Let's just see how Target's been doing. Walmart's dividend's 0.8%. Target had a much higher dividend, 3.79. PE's at a 14.6. Target also had their own problems with going woke. And, beginning of the year, they were at 100 and now they're at 120. So I'm 20% there. So Target's had a much better run than, like say any tech name right now. You throw out a tech name. Let's take a look at Microsoft. Are they up 20% on the year? Nope, not even close, right? We started the year at 472. We're sitting at 370. So I'm much more inclined right now to buy a Microsoft. And like I said, I did buy this last week and get, basically half a share. And for the $200 we put in, I'm comfortable with that. Now, I still think that Target and Walmart are great stocks. And Costco's a great stock to hold long term. But I think I'm going to get more return on something like a Microsoft right now. So Celsius. Also a rough year so far, right? We're looking at 47.75 to start the year, and now we're sitting at 34.08, right? So over the last month, still down, right? We're still from pretty much start of Iran conflict. We're at 43.70. We're down like 9, 11, $10, something like that. Yeah. We're down a good bit here. So it's painful, right? It's definitely painful, but do you believe in this long term, right? And that's really where you want to ask yourself, really, where do I want to put my money? Sorry, guys, I had the wrong one pulled up. We're looking at Celsius. We're down significantly. Analyst research on Celsius, we should have a decent amount of upside. I know they've got competition coming into the market as well, but 102% of upside. I'm comfortable taking that risk. It's less tied to war. It's less tied to, there is some inflation, but the tariffs aren't really there. We are worried about consumer spending, and do people buy as much Celsius if they're not going out as much, if they're not traveling as much, if they're not going to the gas station because they're trying to stay home a little bit more? Do we worry about just filling up the gas tank, bringing a water from home or coffee from home? There's a lot of other options when it comes to the drink space category. So we are concerned about that. So I'll get back to where we're looking for this week. I was watching Netflix. This thing has done pretty well for the year. We did start around 91. We got down into the 70s. That was probably your best time to buy this thing within the past couple months. And then we kind of took back off, right? So this is why you don't want to sell when it goes down, maybe from 90 and then you get down to 80 and you're like, you know what, I'm going to sell this thing. And then you don't buy back in when it hits 75, and then it just rockets back up to 97, and then you missed it, and you sold your shares that you had at like $85, right? So that's what I'm saying. I don't want to see you guys sell out, run for the hills, and then something takes back off, and then you're like, man, the market is just out to get me. It's more so you're out to get yourself by selling too early and not having a plan for your stocks, right? So Netflix, I'm still happy with this one. We got some shares. Paid a fair amount for them at $91. I think I tried to buy some more in the 70s. I think I picked up a couple shares in one of the accounts. I'm still not too certain as to what happens with Adobe here. I really, really like the fact that Amazon's reports have now 3 businesses that make over $100 billion per year. And that was AWS, third-party sellers, and their marketplace for all their goods, right? So Adobe, man, started the year at 329. It's at 242. I feel pretty strongly that this stock could be purchased, and we're seeing a lot of the pain in the software. Man, is it over yet? Oh man, that's a tough question. We're looking at a stock that is at a 14 times multiple. We could dive a little bit closer into the numbers. 31% of upside. I think I just had that pulled up. Salesforce also in that software type space, 41% of upside. That might be a little bit better insulated. They've already got a lot of the AI agents already going for Salesforce. So CRM with 41% of upside versus Adobe, I'd probably go Salesforce. They're already leaning into AI a little bit ahead of the curve. CRM versus Adobe, that is. Adobe, I know they're trying to roll out AI, but can people use other services to do what Adobe's doing with AI? I think they probably could. So I would go Salesforce. AMD, you guys know my thoughts. AMD is still a great company to buy. 31% of upside. I think we see that by that 12-month period. I don't think that that's going to be so hard to get to, right? 285. You get a couple things out of the way with the problems in the Middle East. We get some tariff talk done. 400 chips are rolling out. We got a lot of good things going for AMD. So I really like AMD. AMD versus CRM. I'd probably go AMD. Do I think CRM's got more of a pull down from software selling off? Yeah, I probably do. But I still am probably more comfortable buying AMD or NVIDIA, Microsoft, or Amazon, right? So Amazon, I just told you guys they got those 3 businesses now making over $100 billion per year. And now you're looking at Amazon at 35% of upside or AMD at 4%. I still think that Amazon, for some reason, hasn't really moved, right? AMD already had that massive run. Micron already had that massive run. Amazon is a huge stock, don't get me wrong. But in the past couple of years, it's been fairly sideways, right? Like if I go ahead and pull up the Refinitiv report, and let's just go ahead and take a look at this. If I look at Amazon over the past 5 years, I mean, I'm going to say it's only 32%, but it's only 32%. Right. And I mean, like we just said, the S&P tends to return 7 to 10% per year on average. So this is under that, even though they've been doing okay. It hasn't been hateful, but it hasn't been, just setting the world on fire either. So I really do like this company. They have a lot of different businesses. They got a lot of different levers to pull. I said there's 3 businesses that make over $100 billion, but they have a lot of other businesses that aren't quite doing $100 billion yet. So price target's looking up. What's the PEG ratio here? Annual revenue, 12%, and then 25%. Nice even staircase up. That's nice to see. We've got PEG ratios. Well, their forward PE is cut in half, right? It's a 27.2 and the 5-year average of 52.5. So that's a 48% discount. Do I think that we're going to get back to a 52 times forward PE? I don't. I think maybe we land in the mid 30s, but I don't know that we're getting back to 52 without a severe pull forward. I don't think that we're getting there. Big ratio, we're at a 1.4 versus a 1.8. So yeah, I mean, do I think it's going to just set the world on fire? No, but I still believe that we can get back to some kind of common ground. And it's a solid growing double-digit yearly companies. Amazon I don't think they get the respect that they quite deserve. Similar to some other stocks in the past couple of years. I mean, Apple kind of comes to mind a couple of years where they weren't really getting that love. Google definitely comes to mind where they weren't getting the love and then it just rallied. I do think we could have that quick 3 to 4 month run where Amazon just gets back to where they need to be. And then, we're trying to find new ground. So I definitely think that is out there for AMZ. Now, it just really becomes where do you want to park your money right now? Microsoft has had a severe sell-off. I still really like the company. So I'm between like 5 names on this list right now. I'm between CRM, AMD, NVIDIA, Microsoft, and Amazon. We just bought Microsoft. Amazon is one of my larger positions, but I really want to see that thing start to run. I don't know that there's going to be severe downside to Amazon. I mean, this says 16%. Could we hit that? Sure. But I don't really see that we're getting, run for the hills from Amazon. I really don't. Microsoft has got that decent amount of upside here as well, 6%. And like I said, we just bought it last week because of the fact that we had a lot of upside, and it's a stock that I think is traded too low. NVIDIA, another major player that we talk about all the time, still with 54% of upside. So all of them I think you can buy, and that makes it really hard to decide which one you want to put your money in a given week. And while I say all these names, I know we have a huge position in the investing challenge for Amazon, Microsoft, Nvidia, AMD. So I guess I go with CRM to even it out a little bit. CRM, I'm going to go $200. Do we want to double into another one? Sure. Why not? Let's say we do 100 in, we just did Microsoft. So let's go 100 on AMD. Let's go 100 on Amazon. And that's not to say that I don't like Nvidia. I do. I really, really do. But I want to see what those picks are going to do for us. So CRM 200, AMD 100, and Amazon 100. That's my rules, guys. I'm buying what I'm buying because I like the three names. They're sold off too far. They're too cheap, and I want more shares. I'm greedy. Give me all the shares. Netflix, like I said, that already ran too much. Nike, I think we got time on that one. I think if we want to start building a base here, that's fine. I might buy some more shares for Nike for myself, but that's not in the investing challenge. That's going to be separate. So I might add some more there, but I do believe you got a long time to build a position in Nike if you want to go ahead and start buying that. But don't think that it's going to turn around overnight. Don't go all in. We're dollar cost averaging. That's what we're doing. That's what I want to see. That's what I'm here to tell you. Thank you guys for stopping by. Happy Easter, and I'm going to get back to it. So take care and have a good one.